We all believe that this euphoria is going to carry us with Trump, and there's no, all of the craziness is behind us, all of the debt is behind us, all of this bad stuff is behind us, so the market can go forever. Yet the insiders are bailing, and Warren Buffett's sitting on over, $40 billion in cash.
When bond yields start rising, equities go with it. They go into new high ground. But there comes a point, perhaps after a bit of a pause, where there's another wave of rising bond yields, and it's that kills the equity bull. We're going to see that, I think, in 2025.
When this whole thing goes down, mark my words, the great taking is very real, and a lot of people, a huge amount of people, are going to be left with nothing.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for December 30th, 2024 through January 6th, 2025 while supplies last. This week we feature 2024 1-ounce silver eagles at just $4.85 over spot, one of the lowest premiums we've seen in years. We have a limited supply, so these are first come, first serve. Next, 2024 1/10-ounce gold eagles are just $44.99 over melt per coin. We also have an incredible deal on XF $20 gold Liberty coins at just $75 over melt, one of the lowest premiums on pre-33 gold we've seen in a long time. And finally, 1/10-ounce gold Britannia are just $29.99 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We have an all-star year-end panel. We've got Andy Schectman, the CEO of Miles Franklin Precious Metals. We've got Bill Holter, also a metals analyst and broker, as well as a former Wall Street trading office manager. We're expecting and hoping for Alasdair Macleod, former bank director, to join in. We have the Liberty and Finance team, myself, Dunnigan Kaiser, and my sons, Elijah K. Johnson and Kaiser Johnson, with us. And we're here for a 2024 year in review and a 2025 look ahead. And I'd like to kick us off with an invitation to Andy and then to Bill to highlight what you consider to be perhaps your approximately 3 biggest takeaways from the year in review here on 2024. I know in my recent discussions with others on that, I've talked about gold breaking through to a new all-time highs against the dollar, silver for a good part of the year breaking through the $30 U.S. ceiling that had been subject to and resistance for some time, Fed fighting inflation, supposedly Trump being elected, what that means, and record buying of physical gold by the central banks of the world, notably Russia, China, India, and a few others, and off-taking from the major exchanges. And any other things in addition to those things in particular that you want to emphasize, Andy, or anything else that jumps out to you as you look across in the big picture of 2024?
Well, yeah, I think we have to first, in terms of this center around precious metals, yeah. The central bank's buying at a level the world has never seen. And in fact, over the last 2 months, their numbers have gone up twice the 12-month moving average. This is a trend that is capping the year at a ferocious pace. They're not stopping their accumulation. They're just being a little bit more clandestine about it, if you will. They're being less transparent, less forthright, less open, and the import-export numbers coming out of London and Switzerland are somewhat paying reference to that. Of course, that's a big deal, right? But maybe not as big of a deal as a change in administration, of course. And I think most of us here would say we feel blessed that Trump has won the election and that we'll transition into hopefully getting our culture back. We've lived through 4 years worth of bizarro world where everything that all of us who I think thank God every day without putting words in your mouths that we were born in this country that gave us the opportunities that it did, where we worked hard and our merit was something that was valued rather than our lifestyle, where we didn't have to worry about walking the city streets at night, where election integrity, the integrity of our pillars of our society, the FBI, as an example, the judicial system. All of these things just went haywire. And so for me, it's a real big deal, huge deal that we are moving in a direction of getting our culture back. And you know, I think that to me is more important than just about anything else financially. So for me, the two big deals are not only a continuation of the rampant purchasing by the central banks, but actually a doubling down as we get close to the end of the year, and bringing Trump on board to restore sanity to our culture, to the things that made Americans feel special about being an American. To me, those are the two things that stand out more than anything.
Thanks, Andy. Bill, any thoughts from you on your key takeaways and observations of 2024?
Yeah, I agree with Andy. I think that the easiest, shortest way to say it is woke is dying. DEI is dying. Global warming. I mean, all of these things that are just ridiculous are dying and are being, you know, the curtain's being pulled back. I think this year there was a sea change in, I guess I'll use the V word. The V word has been exposed for what it was. So, you know, that's a good thing that the curtain got pulled back on that. From a financial standpoint, this year the U.S. paid over $1 trillion in interest only. And this is the year, I think, where the math is just starting to bite the system. The math is completely untenable, meaning the U.S. is insolvent and the U.S. issues the world's reserve currency. So you have a world's reserve currency issued by an insolvent. So I think that's very important. Yes, I absolutely agree. The change of administration is important, but I also would caution, just because of some of the things they're already talking about, the Noahide laws, I think early in this administration, we're going to find out that the First Amendment is going to be under attack. I know that sounds strange because of all the censorship that we've had in the past. But I think early in this administration, we're going to find out. We're going to find out the real nuts and bolts of the Trump administration. I'm not really happy with several or quite a few of his cabinet picks. And I also believe that the world is going to figure out that, you know, in Trump, nobody can fix what's already been done because it's math, and the math it's already in the oven and on fire.
That beats baked in the cake. Both of you mentioned accumulation of physical precious metals. Andy, you had emphasized it by the central banks of the world. And then you said doubling down at the end of the year. There was a apparent lull, like in third quarter, where people said, oh, maybe they're taking a break or something. But then there emerged a story beneath the story about the off-balance sheet and out of exchange methods and pathways of physical metal accumulation by the East. Can you emphasize that for those who aren't aware of that?
Yeah, well, you had China telling us that they took 6 months off from accumulating metals, which really wasn't true. In fact, the import-export numbers showed anything but that. And they were kind of caught. You saw the same thing with Saudi Arabia. Saudi Arabia importing metals that, again, attempted to not be reported to the IMF. And the numbers are far, far, far in excess of what we are being told. Aside from that, we see, for example, as we've talked about on your show a bunch, I've had numerous confirmations from mining executives that have told me, indeed, that China's flying all around the world, mostly in South America, and buying up doré and concentrate from the miners directly, which is disintermediating the marketplace, and it doesn't get reflected in the price or calculated in terms of how much they're actually buying. And it's not just silver, it's gold as well. Although 70+% of the silver they're using in industry is coming from concentrate purchases, where they're buying sludge in excess, in essence, rather, directly from the miners, paying more than the West will, sending it back to China and refining it. And so what we are seeing by all of these countries is a way for them to accumulate metal without it being cataloged or the IMF keeping track of it. And the PBOC is just a very small part of Chinese gold accumulation. The People's Liberation Army is thought to have as much or more as the PBOC because they are not required to report it directly to the IMF. Or as we were saying with the concentrate of the Dory, if metal is purchased that is under the 999 or 995 purity, that's not reported. Or if it's being accumulated by proxy, if you will, by commercial banks on behalf of the PBOC, that's not reported. And the same thing is going on with Saudi Arabia, and the same thing is going on with India. These are very large state-sponsored sovereign wealth funds that aren't reporting it. The thing about what you're mentioning in particular is that the PBOC said we stopped buying gold for 6 months. In essence, they didn't. They just stopped reporting it and tried to hide it much more keenly, if you will. And I think it doesn't do anyone any good in a world where they're all racing to accumulate gold for some reason. Does it have anything to do with the Tier 1 revision? Does it have anything to do with all of the banks, what appears to be the central banks, setting the stage for maybe some sort of a gold revaluation? It doesn't behoove them to let the world know how much they're buying. And I think the import-export numbers kind of caught them trying to do that. And if that's what they're getting caught with, my guess is there's a whole lot more they're not telling us about in terms of the way that they are very privately accumulating things around the world so that it's not directly a state-sponsored accumulation, but doing so kind of on the sly. And I think that is one of the things that I would take away from 2024 as well. And that is that massive accumulation and trying their best to kind of hide exactly how much they're accumulating and producing, for that matter, as well.
And I think one very interesting thing about this year is we finally saw the metals run quite significantly, about 30% increase in gold and silver. I guess starting with Bill, your take on this, and then also where the prices are going, maybe below some key levels right before the end of the year.
I do want to add to what Andy was talking about. Absolutely, you've got China trying to buy directly from miners. And that's a huge deal because that means there's going to be less metal that'll make it to refiners and thus less metal available for LBMA and for COMEX. One other thing is that very interesting, back in, I think it was October, Russia announced that they were going to be purchasing other commodities, and the first one they named was silver. And I mean, the supply and demand is on a knife's edge. So you get, additional demand is going to blow up the supply. From a short-term, technical standpoint, we're oversold again. I mean, we've seen multiple times this past year where the metals bottomed. I posted, and I think Andy, you posted my charts also, showing the bottom hooks. And I think what that illustrates is exactly what Andy was talking about, central banks stepping up and creating demand for gold. Not so much silver directly, but silver's going to move with gold. So I think that is definitely significant. And I really don't think it's important, if you're wanting to know, should I buy at 29? Should I buy at 27.75 or whatever? Who knows? And when all is said and done, it's not going to matter. The whole idea is that you're getting your capital out of the system and into something that cannot bankrupt. Because when this whole thing goes down, mark my words, the great taking is very real. And a lot of people, a huge amount of people, are going to be left with nothing.
Bill, I wanted to get your comments on that topic because we've seen over the past year remarkable selling to buying ratios among insiders, insider trades that are remarkably diverse. You know, the CEOs and the people at the biggest stockholders are rotating out of stocks, and we've seen a lot of volatility in the major equity indices this year. Can you talk to us about Wall Street? And some people thought, man, with Trump being elected, it's going to be off to the races. Happy days are going to be here again for the economy, et cetera. But I'd like to hear your observation of the second half of this year in particular regarding stock market ownership and performance.
Yeah, we've seen huge insider selling. And who's going to know the situation of a company better than an insider? I mean, to answer the why, it's because they know. They know something that the majority don't know. They can see it from the inside out, and they're getting their capital out. There's always the saying, "Don't fight the Fed." I would say also don't fight the insiders because they know better than you do. They know better than anyone.
We saw a number of charts posted recently. One of them was Warren Buffett raising all-time high level of cash position. Any other comments from Andy or Bill on the dry powder being held? We heard that also from other major long-time market analysts and investors. But your thoughts on that?
Jeff Bezos has sold another $1.25 billion worth of Amazon in November, bringing his total up to almost $13 billion for the year. Zuckerberg cashed out $153 million worth of Meta stock last month. That brings him up to $2.4 billion over the last 12 months. And insiders in NVIDIA have sold over $2 billion year to date. And so, as Bill was saying, you have the insiders. Right now, it's a 6-to-1 discrepancy between insider buying and selling. You have 6 sellers on the inside for every 1 buyer. And this is at a period of time where over half the country feels that there's less than a 10% chance of a market crash. So you have the insiders leaving, and you have this irrational exuberance by the public. And I know that we've already closed this door, but I just found what I wanted to mention. China said they went 6 months without buying anything and then bought 5 tons in November. The London import-export number said they bought 60 tons in September and 55 tons in October. They never reported it. So not as your eyes lied to you, I think, is what we're really trying to get at with a lot of this stuff, whether it be the strength in the marketplace, where we all believe that this euphoria is going to carry us with Trump, and there's no, all of the craziness is behind us, all of the debt is behind us, all of this bad stuff is behind us, so the market can go forever. Yet the insiders are bailing, and Warren Buffett's sitting on over, $40 billion in cash. The same thing is true about the numbers that we're being told by the IMF, how much gold is being accumulated by the central banks. And they're using the Western suppression to run cover for it. And that's a prime example. China says we didn't buy anymore. That's 115 tons unaccounted for that they did buy over 2 months. That's just 2 of the 6 months they said they didn't buy. Anyways, I think that's kind of a common theme, is that what we are seeing is less than, at best, it's truth. And I think at some point, we have to start to see these things come together where, the logic and the truth has to reflect in price, has to reflect in outcome. So it gets maddening, I'm sure, for people to listen to this stuff over and over and over again. But at some point, reality has to, the rubber has to meet the road, I guess is what I'm trying to say. Maybe that happens this coming year.
Well, I wanted to bring it back to the roots of this channel. Liberty and Finance originally was Reluctant Preppers. The whole idea was trying to get the word out to ordinary moms and pops, heads of household, people who had direct financial responsibility for their own family and for their greater extended family, for the interest of their community, et cetera. And that is that repeatedly throughout history, we see that the powers that be that are well-connected, that have the inside information, take care of themselves, whether it's through laws that favor them or whether it's through favorable tax structures or whatever, whether it's through actions that are clandestine and covert and misdirected, as you have said over and over again, Andy. And then as you said, the little man rule is that by the time the little man makes his move, the big guys have already all made theirs, and he's positioned. He's doing it exactly at the wrong time. We see then the lemmings all falling over the cliff. Bill, you've been heart and center in a number of stock market rollovers in the past. You were on Wall Street and you saw the way that happens. Any perspective from you to help our viewers who are trying to decide, gee, do I follow the herd into this momentum market? Because as long as there's momentum, you're going to keep coming out finding more people are going to be buying that. You don't want to be left out of the next leg up, and that's what their financial advisors are telling them in the retail financial advisor space, et cetera. Your view as a former Wall Street branch manager.
Yeah, I mean, I've seen it all going back to, I was a broker during the 87 crash. So, I watched the reflations, I watched the credit bubbles, I watched the credit bubbles blow up. And we are in a global credit bubble not ever seen in the history of man. And I would just tell you that all credit bubbles blow up throughout history. I mean, you can go back hundreds of years and every credit bubble ever has blown up. And that's where we're headed. I do want to mention, as long as we're talking about the stock market, you mentioned Warren Buffett. Warren Buffett, I mean, I can remember back in 1998, 99, people were saying, Warren Buffett's washed up because he wasn't buying the dot-coms. He was raising cash. He had a huge amount of cash going into 2000, 2001. And of course, the market cracked. Same thing happened again in 2007, 2008. He was raising cash, and he now, I think the number's 145 billion in cash is what he's sitting on. And that is the largest amount of cash outright, and the largest amount as a percentage that Berkshire has ever held. So the reasoning behind him raising cash, and I mean, he says this himself, is that he can't find anything of value or of good value to purchase. So cash is a better place to sit. Now, I do believe that when this does go down, Warren Buffett is going to find out that he's sitting on the wrong type of cash, because ultimately gold and silver, they are real monies. And historically, you went to cash for safety. And if you've got a credit event happening, how safe are some of these sovereign debt securities going to be? I think we're going to find out that, not everything's AAA rated, not everything's safe. And we're going to find a bunch of sovereigns that get discounted and downgraded, maybe even completely collapse.
Wanted to take a moment to welcome Alasdair Macleod, former bank director and founder of Macleod Finance. Alasdair, thank you for joining us for this end of year 2024 and 2025 look ahead all-star panel. Thank you for coming.
My pleasure.
We are trying to make the rounds, asking everyone their key takeaways from the year in review here for 2024. One or two or three primary things that press to the front of your mind about the most noteworthy occurrences or trends that you see coming through 2024 that you could share with us?
Well, I think, select any one of 100, I suppose. What would I have noticed? I mean, basically, the credit bubble has continued to inflate, if you like, and we're now on the verge of seeing interest rates going into new highs. Not interest rates, sorry, bond yields. Interest rates will have to follow, I suppose. And that'll pop the bubble. So we've seen if you like, I think the best of markets, and I'm referring to equity markets, Bitcoin, all that sort of stuff, the stuff which really needs credit to inflate its values. I think those days are now dying, and that, I think, was the big feature of 2024. I think the other thing I'd say is that as far as the bullion banks are concerned, gold rising 26, 27% on the year shouldn't have happened when money supply increased only 3%. So what's going on? I think around here we know basically there's a decline, if you like, in the faith of the dollar. As I keep on trying to tell people, it's not gold going up, it's the dollar going down. But I mean, I think that's the stark reality. 27% increase or 26, whatever we end up with, whereas US money supplies increased by 3%. And this is telling me, anyway, that faith in the currency is really beginning to decline now. And I think that's probably the most notable development that we've seen in 2024.
I have to confess that when you first brought up that way of expressing it, that it's not prices going up, it's the currency going down in value, I first thought of it, well, what's the value of saying that statement? And then the more I reflected on it, the more I realized how barren the soil of my mind was, because we've become so accustomed to thinking of and measuring everything in the currency. And people who say, oh, I made a profit on the stock market, I flipped this or I flipped that and I came out ahead, they're always talking in terms of nominal value of a currency that's been declining precipitously since 1913 and even accelerating recently. So when you make that mental shift to realizing the currency is just going to continue its downward spiral, then flipping back into something that's dying takes on a very different perspective than realizing, no, you've got to hold on to things that are real. You've been counseling us in that direction and our viewers for some time. Do you have any thoughts about the flow of physical metals in 2024 as you look back to what was supposedly a major purchasing campaign by some major Eastern central banks, but then we heard that there were even non-standard routes being taken to keep those numbers looking less eye-catching than they perhaps truly were? Any observations from you?
Yeah, I mean, we can sort of discuss details about how, for example, the stands for delivery on COMEX are just going on all the time. What does it mean? And all this sort of stuff. But the reality is that increasing numbers of central banks do realize that the risk in their reserves is in the fiat currencies. And so, in effect, they've been selling fiat currencies to buy real money, real legal money, which, the Romans first classified as legal money in 448 BC with the 12 tables. Admittedly, gold wasn't in it then. It was sort of, copper, brass type thing, and gold came later. But, and if you look at Diocletian's edicts, which I think were 305 AD, so 800 years after the first Roman laws came out, and you look at the prices, the maximum prices that were permitted under the edict, and we don't have slave markets anymore, so we can't compare them. But there are various, things like, army boots and greatcoats and togas and, beer was another one, where the prices actually today expressed in gold are really quite similar. And that's the whole point about, in money. The growth of above ground stocks has more or less kept pace with global population, averaging around about sort of 1.5–2% per annum. So it's not surprising that, there is a balance, if you like, in the whole thing, which means that the purchasing power of gold remains constant. All the other fiat crap, it just basically loses it and loses it and loses it. And it loses it. Normally it's an interesting one because the monetarists, they do understand the dilution, if you like, of purchasing power of a currency, which they call monetary inflation. That's one aspect of it. But the other aspect, which they haven't really grasped, is that it actually depends. The value of a currency depends on the faith in it. And it's that faith which is now being eroded. This is why I mentioned 27% increase in the price of gold, or put another way, the dollar in gold has lost a quarter of its value in the last year, whereas money supplies only increased 3%. What's that telling us? It's telling us that the dollar is actually on a very slippery slope. But the thing that's sort of surprising in a way to some people is that the dollar is the strongest currency. I mean, you look at the trade weighted, look at the chart of it. It's got a golden cross under it. Dollar's going up. Yeah, of course it's going up because all the other rubbish is even worse. So, but measured in gold, I mean, here I am in the UK and we've got a new socialist government. Nobody here has really bought gold, but it's the one thing to have because sterling's going to go down against the dollar's going to go down against gold, interest rates, or rather bond yields, are going to rise, which is going to destroy capital markets completely. There's only one thing you can have when credit is collapsing, which is effectively what's happening, and that is gold. And I think that's really the outlook for 2025. I'm probably jumping the gun.
No, we're about to turn the page. That's just fine. And I just wanted a chance for the Liberty and Finance team. Anybody have any comments on, for example, we saw retail premiums lower than we've seen in 3 or 4 years on investable products this year, gold and silver, and better availability and a bit of a lull in volume of action. Various theories I've heard even from our clients and subscribers as comments. Some people say when times get tough, people are tapped out and they feel like they're just trying to make their bill payments at the end of the month, and they don't feel like they can stack as much as they were able to even a few years ago. We've seen a shift in increased buybacks or sellbacks, people needing to raise cash to pay taxes, et cetera. Any comments on 2024 trends at the retail broker level from any of the retail brokers on the panel?
I would say one thing we've seen is probably, to my reckoning, maybe 5 times as many sellers as we have over the last few years. I think, most of our the trades that we were doing over the course of the last 3-4 years have been probably 95% purchases and 5% sales. And I would say now it's more like 70-30, 75-25, something like that, where easily we're seeing many, many more sellers than buyers. A lot of it is people saying, I've got to pay for taxes. I got to pay my property taxes. I got to pay these expenses here. I need to, position myself differently. And unfortunately for a lot of sellers, it's really been a buyer's market because of how the way that the retail premiums have come down and the spot prices come down. We saw a silver peak 2 months ago here at above 35, and now we're down below 29 this morning. And so it's been an interesting thing and that is, I guess, one of the ways that a buyer's market happens is when you have more sellers than buyers, and then this outside pressure as well. But that's one big takeaway I've seen is that we've been seeing, I would say, easily somewhere between 3 and 5 times as many sellers as we had in the past over the last few years.
Because we know how low a percentage of overall investments are in precious metals across the board, that always hurts my feelings to see that happening at the individual level of families. However, I have to acknowledge that those people who purchased these, 2, 3, 4 years ago, whatever, are getting a lot more, that their savings have held up better than if they had been in the bank. And we haven't even talked about the banking system at all yet. And I wanted to wait for 2025, look ahead for that. But any comments from you, Elijah, before we turn the page to 2025?
Yeah, and I think also getting any of our guests' opinions on this as well, I think would be fantastic, because I think one of the things that is striking to me, how we're talking about the fundamentals and how we might be headed towards, a major credit crisis where we could continue to see inflation. Kind of the mainstream narrative right now is that inflation is under control, pretty much. But if, we're seeing gold and silver rise about 30% this year, maybe, the metals are anticipating something dramatic coming soon. And we've seen dramatic things happen in the metals markets before where, pretty much all inventory is wiped out. I remember back in March and April of 2023, it was, we were telling clients 4 weeks until we can even ship anything, pretty much, even if you're paying by wire. So, and I know, Andy, back in 2008, you said for like 3 months or so, you guys were just completely out of product. So it seems like right now is a perfect opportunity where premiums are low, prices are, depressed, compared to where they were maybe a month or two ago. And we might be at a time right before we could see significant inflation in 2025. So I guess any thoughts from you, Andy, or Bill, or Alasdair regarding, is right now a perfect time to kind of dip your toes more into the market?
Well, it's interesting too, Elijah. In that December, there just on COMEX alone, there was 25,642 gold contracts delivered, the second highest delivery volume in almost 3 years. And in silver, it was ridiculously high as well. And so what we're seeing is the insiders, the big money, the central banks, the sovereign wealth funds, they're standing for delivery, as the retail investor has been, I think, mesmerized by the shiny objects over there, the Bitcoin and the Nvidia and the Apple and all of these stocks and cryptocurrencies that are posting returns. And I remember Richard Russell saying, if you make 7% a year, you're a rock star. And now gold making 30%, as you mentioned, in a year doesn't excite anybody. And that's very dangerous. But I guess at the same time, what I'm really getting at is, you're right. The selling has been stronger than at any time since 2017, but so too has very large purchases by people who understand what's happening. So the person looking to make a profit, which I think is not the reason to buy gold and silver, they're looking elsewhere. The people who are looking to preserve and understand economics, understand that the math, as Bill always says, is moving into an area that is not sustainable. Well, they're contributing larger amounts of money into gold and silver, maybe even first-time clients. But the trend that I see is of the public looking elsewhere as the insiders are draining the exchanges. And that's classic misdirection, and that should portray for higher prices down the road, if I had to guess.
If I can jump in on what you just mentioned there, Andy, I think it's a really interesting point that, by and large, the sort of traditional investment community doesn't really have an understanding of. You look at financial, a lot of just kind of retail financial advisors and people like, financial gurus like that a lot of people look to, like Dave Ramsey or that kind of thing, where they kind of denigrate the idea of physical gold and silver. And they go, look, if you want exposure to it, fine, you can have it, but buy SLV and buy GLD and trade those to make your money, or sit on the exchanges and just have that. Where the point that I think a lot of financial advisors and people like that are missing is, the point is not to have it as a speculative investment. The point is to have something in your possession of tangible value as what you have relied on for value. This dollar, as we see it decreasing precipitously in relationship to actual assets. You can see that in the housing market. You can see that in gold, where there's an actual asset, the dollar is falling rapidly compared to it. And so this idea of, well, you make 8% on this stock market if you just hold the Dow, and that kind of thing it's like, that's missing the point entirely. I think that's a really important thing that you bring up. Alasdair and Bill, any thoughts on that? The contrast between the retail investors eschewing tangible assets and the insiders gathering those before we turn to 2025?
Yeah, sure. My experience, long-standing experience as a stockbroker, is that markets tend to move in about three waves. I mean, this is true of equity markets, but the psychology, I think, is very, very similar. And that is, after a bear market, the only people who participate early in the next bull market are basically the people who really know what they're doing. The real pros, the guys, for example, sort of in, let's say the mining industry, something like that, who understand mines. They're in there buying stuff, and it's sort of accumulating in their hands. You get M&A activity. This sort of thing begins to build. And as the M&A activity begins to build, then you find that there's a wider investment community, but again, very much investment managers, experienced guys who will go in and drive the second wave. And towards the end of the second wave, some of the public begin to sort of think, markets are going up. Perhaps we ought to buy some. You then get another correction. I mean, Elliott wave fans will know, will feel the description. But then the last bit is the last bit of the bull market is where all the idiots, who've missed it, pile in because they know they're missing something and it's going up, and they buy it just because it's going up. Now, we are, if you like, in those terms, in phase one. And so to see the public selling while the professionals are buying, which is what Andy was saying, is exactly what's been going on. It's that very, very early stage. You can take these comparisons a bit too far because obviously we're not talking about investment, we're talking about protection. And we're talking about getting out of credit and getting into money. But the psychology basically is the same. I mean, even Germany, who's had two wipeouts, currency wipeouts, since the 1920s, 1923 and also following the Second World War. I mean, they're not buying gold. People are not buying gold. They're not sort of putting some aside. They've been selling. And if you look at, ETFs, the dreaded ETFs, which are not a substitute for gold or silver, it's only recently that there has been a little bit of buying, if you like, in Western capital markets. But that buying hasn't been really individuals. It's been some of the funds, run by guys who maybe listen to us a little bit and have got this sort of idea that gold is actually something you should have, or a little bit of silver if you want to speculate on EV and all this sort of stuff. So it's only just starting. And so really to summarize, the fact that the retail market has been sellers this year, while the professionals have been buying, is actually the clearest indication that you've got that this is in the very, very early stages of a big, big bull move.
Bill, any thoughts for you before we turn to 2025 on that?
Yeah, the little guy, I mean, I think all of us have noticed that, we've got more sales this year than probably the previous 3, 4, maybe even 5 years combined. I believe that is not a function of, if you want to call it financial markets. I believe that's a function of the real economy. The real economy, because of inflation, because of joblessness that's not reported, people are needing to fall back on their savings. And we as gold, silver people, we've seen these people buy over the years. We didn't see them sell because the real economy was not as crappy as it is right now. The real economy worldwide is slowing down. Now, I've talked about this probably 10 times in the last 3 or 4 months. But if you took, I use just the US, but it should be looked at it worldwide. If you took the deficit spending that the US has done just over the last 5 years, $15 trillion of accumulated deficits. If we didn't have those deficits, that money, that 15 trillion, would not have been part of the real economy. It would not have been part of GDP. And we would have been reporting, instead of 1.5, 2.5, 3% growth, we would have been reporting 3, 4, 5, 7% decline. And that's the case worldwide. The deficit spending, the use of credit, is masking the fact that GDP is no longer getting a boost by a multiple of every dollar that's borrowed. It's actually getting a boost of less than 1-to-1 for those deficits that have been borrowed. So there's your math right there. I mean, we've hit debt saturation.
I want to turn on that note, if we can, to 2025. I know, Andy, you have a shorter timeline, so we're going to try to let you go first. And Alasdair, I want you to give us an update on the banking situation, because, Bill, you've talked about basically insolvent nations all around the world who are making it appear as though their GDPs are sustaining by just using government debt to make it to artificially increase activity in the economy. It's not the real physical economy. And Alasdair, you've talked to us about risks to the banking system for years now, and we saw a pretty sharp exposure of that in 2023. But now most people have fallen back to sleep, thinking that that's gone away. Andy, you've been watching these trends as well, and would like you to give us a chance to look ahead into your view of 2025. There's some mega trends that you've been following: the BRICS nations, drawing down of metals off the major exchanges, all these sort of things. What are things that are front and center of your mind as you look into 2025?
I know a lot of the rhetoric surrounding the BRICS nations has somewhat died down. I expect to see a reemergence of this discussion in 2025. Trump saying he'll enact 100% tariffs on the BRICS nations for continuing their desire to move away from the dollar. That's not a tariff. Tariff protects manufacturing, domestic manufacturing. That is a sanction masquerading as a tariff. That is financial warfare. That is not something that I think will dissuade the BRICS from continuing to move forward. I think that from a domestic standpoint, I think the debt issue is something that has to be front and center. I mean, even Trump just sent out a tweet the other night saying, thanks to what the Democrats have done, 2025 could be a 1929 style depression. You look at the latest Treasury data that was just released for November, which was the second month of fiscal 2025. The U.S. spent $584 billion for October and November. That's the first 2 months of 2025 for the fiscal calendar year that Trump is inheriting are officially the worst start to a year ever for the Treasury. When I look at gold acquisitions, again, China doesn't buy gold for no reason. And they've bought 1,000 tons since the start. That's what they tell us, since the start of the Ukrainian war. At the same time, they've sold $250 billion of our U.S. treasuries. This is a trend that will continue. This de-dollarization will continue. I think they'll continue to accumulate gold rather than try to devalue their yuan against the dollar. They'll let it happen organically by accumulating gold. I think that's something certainly to focus on. Of course, it's the bond market. At the same time, I think the bond market are with the Fed creating trillions to fund these deficits, that not only that they're inheriting, but the debt that is coming due. I think the bond market's getting very nervous that they see inflation coming back, that the ballooning U.S. debt is something that has to be dealt with, and how many treasury securities will have to be created to do so. At the same time, many of the countries that traditionally supported our debt are moving in the other direction. So I think that's something that we'll have to continue to watch very, very closely. But yeah, I mean, if I had to guess, I would say also we're not out of the woods yet regarding the banks. And I'll keep coming back to what happened in Lindsay, Oklahoma as a trial balloon. They didn't say a word about it on the media. I mean, it was literally just kind of stuffed under the rug, and yet it's the first bail-in in this country with over $1 trillion in commercial real estate loans coming due in 2025, with interest rates moving higher on the back end. And it's not the federal funds rate that matters. The economy runs on the 10-year Treasury. I mean, the mortgages and the credit cards and the leases and all of these things, they're all about the long end of the bond market, which is moving in the other direction. What havoc is that going to wreak on the banking industry? What havoc is that going to wreak in the commercial real estate? And I keep coming back to this thought of restructuring. I mean, Trump is the bankruptcy king. I mean, is this something that's baked into the cake? Do they know that we're going to have to reset some way? And is he here for that reason? You know, I've done interviews with people like Simon Hunt, who will tell you that he was selected, not elected, and he was selected to usher in this digital surveillance state. He talked months ago with me about they're going to issue a digital ID under the guise of election integrity. What do you know? He just said that. a lot of the things that I guess I'll just simply say this. And someone said it to me very apropos. He said, is Trump the Trojan horse, or is he riding on the Trojan horse? And that, I don't know. And I guess I would just simply say this after what we've been through for the last 4 years. If you don't look at everything cross-eyed, if you don't think outside the box, everything that's presented to us, I think you've missed everything that we lived through for the last 4 years. So as happy as I am that he's here, you have to wonder, what does it ultimately mean? I mean, what better guy to have oversee a bankruptcy or a restructuring or a reset than someone who's known for doing that professionally, maybe better than anyone. So I think there are a lot of things to keep your eye on. Most of them center around debt, and the BRICS have not lost sight of that. So don't underestimate the BRICS. Don't lose sight of the debt. Be optimistic, but understand that they're just like in the Shawshank Redemption, as I said with you before, Dunnigan, you have 2 miles worth of crap to crawl through to get to the other end. And maybe there is reason to be optimistic, but there is no way of getting to that other side without dealing with the mountains of debt and that tunnel full of crap that we have to crawl through. So I think 2025 is going to be a volatile year. And when the president-elect says this next year could be 1929 style depression, thanks to what we've seen already by the Democrats, I think people need to, and then see 6-1 insider selling versus buying. I think we need to be cautiously optimistic into the new year.
Sounds like the emphasis on caution there. Alasdair, you've spoken this for some time about systemic risk in the banking sector. Andy just highlighted toxic commercial loans. We didn't get into how many zombie companies are out there, but in a rising interest rate environment, and Andy mentioned rescheduling of debt, that sort of thing, that higher rates. What are you seeing in the banking industry as health indicators or lack thereof in 2025 as you look ahead?
Well, I think what the banks are doing is what they've also been doing in 24. That is, they're trying to de-risk their balance sheets. Now, an individual bank can reduce its balance sheet. Point being that the leverage within the banking sector is uncomfortably high, and it became uncomfortably high because margins were suppressed at the time when we had zero interest rates. And if you look at the banking systems in Japan and also in the Eurozone, where they went, where the central banks drove interest rates into negative territory, I mean, the leverage there is far greater. So, leverage is a function, if you like, of how the banks responded to the suppression of interest rates. So they're now left with higher interest rates and too much leverage on their balance sheets. They're trying to reduce that. The system as a whole cannot reduce its balance sheet for the very simple reason that once credit is created, it doesn't disappear. I mean, people make the mistake of thinking that, we get into a deal, we do the deal, I pay you, you deliver to me, end of credit. No. What happens is the credit gets passed on to other parties. If I pay you, it goes into your bank account. And if you pay someone else, it goes into someone else's bank account. All that's credit. And even cash is credit. It's not proper money. So the point is that you have the entire system trying to de-risk itself, not by, in aggregate, reducing its overall level of credit, but by, if you like, taking funds away from the private sector and applying them to government, and specifically applying them to government through the T-bill market rather than longer-term maturities. That's the way in which the banking system de-risks itself. The problem with that, obviously, is that it kills the private sector. And, Bill made the point earlier about, the falsity of the GDP numbers, because so much of it is actually the expansion of government credit, which is it's inflationary. It's not productively, it's not credit aimed at production in any sense. Production in the sense that the private sector is producing something that people actually want, that they will actually demand. No, this is credit which is produced by a government which says you will have this, you will have that. Now, this is inflationary. So this is the background against which the banking system operates. Now, there are ways in which the level of outstanding bank credit can be reduced. The first is businesses go bust. And I think we're going to see quite a lot of that in 2025. And the second is that banks go bust. If you look at what happened in the 1930s, when money supply contracted by something like 40%, it weren't because the credit was sort of, if you like, being contracted by the banks. No, it was because banks were going bust and businesses were going bust. When an obligation is no longer available, the credit on the other side disappears. It's completely worthless. So the point about this is that in 2025, as bond yields rise, and particularly the 10-year, we'll see that go through 5%, I think probably in the first quarter of this coming year. If that happens, and I think it will, then you'll find that banks and businesses will be getting into trouble. So what does the Fed do? It will move heaven and earth, Fed and Treasury, move heaven and earth to ensure that no bank defaults on its obligations to its depositors. So what we're looking at, I think, is a bailout of the entire system. But we have an interesting point about the central bank's involvement in this, because the Fed is deeply underwater in negative equity because of all the losses that it has had from the past from QE. And you think the Fed's got problems, just look at the Bank of Japan. I mean, that's just crazy. Any rise in interest rates there, I mean, the whole system sort of threatens to fall over. The ECB is also in the same sort of position, but not quite as bad as the Bank of Japan. Now, you can recapitalize a central bank quite easily. I won't go into how to do it. But the one thing that actually is going to be very, very difficult is to recapitalize the ECB, because the shareholders, or key holders as they call them, are the national central banks. The national central banks, in most cases, will have to go to the political class to get permission to recapitalize themselves and to, if you like, recapitalize their share of the ECB. That's not going to happen. So I can see that the euro actually could be beginning to just completely disappear under these circumstances in, if you like, a global crash. Now, there is going to be a huge, great panic as people realizing the dangers to credit actually start getting out of credit. What the hell do they get into? But if they try and get into, equities, forget equities, because when you see bond yields, particularly US 10-year Treasury bond yields go through 5%, I reckon that US equity markets will crash. It's quite simple, because the relationship between bonds and equities is already very, very stretched. And going back to my experience as a stockbroker, noticing how markets top out, what tends to happen is that when bond yields start rising, equities go with it. They go into new high ground. But there comes a point, perhaps after a bit of a pause, where there's another wave of rising bond yields, and it's that kills the equity bull. We're going to see that, I think, in 2025, which is going to compound the problems for the banking system, because an awful lot of it is the collateral for loans, just in the same way as commercial real estate is the collateral for loans. And then what's going to happen to residential property, where you've got mortgages, where mortgage costs become unaffordable for increasing quantities of homeowners. As collateral, that's going to be perhaps the last to be undermined, but it'll be undermined. So this is, I think the Fed's attempts to keep the show on the road, kick the can down the road one more time, is going to fail. They must try it. And that, of course, will kill the dollar, because the foreigners aren't prepared even to help fund the US deficit at 5%, 6%, 10%, 15%. And the Fed is trying to push rates down at the front end of the yield curve. That's just going to kill the dollar. And that, I think, is basically what we're going to see. So coming back to what you were saying, asking about banks, I think banks will be the last to fail in the sense that they will be supported but it's the whole system which is going to fail. And that's what we face.
Turning now to Bill, your perspective, what are the key things that you're looking for in 2025?
2025, I think 2025 is the year where this comes to a head. We had off record, we were talking about why the Bank of England, I guess it was 2 or 3 weeks ago, announced that they are, as of January 1st, they will not report any bailouts of non-financial or non-bank institutions. And the question is why? Why January 1st? Why 2025? And I mean, what comes to my mind is that there are problems. They know they're going to have to address them in 2025, and they don't want to start, if you want to call it, a cascading bank run by naming names. I also believe that 2025 is going to be the year where you're going to see a differential of market rates, not necessarily interest rates that the central banks are using, but how those sovereign treasury bonds are valued. And I think 2025 is going to be the year where there is discernment between credit A, credit B, credit C, based on risk premia, which does not exist. I mean, if there was risk premia that existed, Japan, you would have interest rates at what? 15, 20, 30%. I mean, they're 300% debt to GDP. You'd see the U.S. with higher rates than what we have. So I think this will be the year where sovereign treasuries are looked at based on their metrics, as opposed to they're just another sovereign. They're just another sovereign treasury, and everything's fine. So I think that's something that's going to come up. And I also think that because the entire system is a Ponzi scheme, we're really looking at a global debt trap from the standpoint of we've reached debt saturation, and any Ponzi scheme cannot continue unless there's new money that comes in. And the way new money is created is largely by debt. I mean, it's no longer printed like it was during Weimar Germany. And the fact that we are at levels now where, looking at the U.S., we're paying over $1 trillion in interest. This year, it'll probably be $1.5 trillion. And within 2 or 3 years, we'll be paying over $2 trillion. And that's if interest rates stay where they are. But to be clear, I do believe interest rates are going to rise from here. So that interest expense is going to come into focus faster and faster. And that blows up the system. It blows up the Ponzi scheme if new money doesn't get borrowed, because that's the lifeblood to both the financial markets and the real economy.
We're up against a time wall, and we wanted to give every one of you the chance to tell people how to find you online. Andy, you first, how people can follow you?
Of course, milesfranklin.com and our YouTube channel, Miles Franklin YouTube channel, the show I do called Little by Little. Best way to find us, I guess, info@milesfranklin.com for any questions. And it's just such an honor to work with your family and with Bill as closely as we do. And that is the best way to find us. I'm not a hard guy to find. I'll put it to you that way.
And just a reminder to those who may be finding Andy here for the first time that he is on our channel, Liberty and Finance, for a weekly market update, typically Wednesday evenings, 9 p.m. Eastern. 8 p.m. Eastern. Bill, how can people find you online?
You can go to my website. It's just billholter.com. There is a contact button. There's a contact button on the website if you need to reach me with my email address or a phone number.
All right. And Alasdair, you've got a new Substack. You want people to be aware of how they can find you there?
Yeah, Macleod Finance, or more correctly, it's alasdairmacleod.substack.com. But if you just Google Macleod Finance, it'll take you there.
Well, gentlemen, thank you so much for joining us here for this weekly market, for this end of year All-Star panel, 2024 in review, 2025 look ahead. There's a lot more that we will need to talk with you about, and we hope to have you guys back on frequently as we can during 2025. And just thank you for coming all together at the same time and same place, same bat channel for all of our viewers and subscribers. And folks, if you are not yet a subscriber, because half of our viewers are not, just click the subscribe button in YouTube and you will be. And also you can get on our free mailing list, libertyandfinance.com, put in your email address, click submit. Make sure you confirm on the confirm email. You'll get 1 email per day in your inbox with our latest guests, Andy, Alasdair, and Bill, and all of our other guests on the weekly specials. Thank you all for joining us here. Everyone in the audience, everyone who can forward this to friends, neighbors, family members, coworkers, please do so. And we'd love to have you here with us as we go through 2025 together. Sounds like it's going to be an eventful year. And thank you everyone for being here.
Happy New Year, everybody.
Yep. Happy New Year.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for December 30th, 2024 through January 6th, 2025 while supplies last. This week we feature 2024 1-ounce silver eagles at just $4.85 over spot, one of the lowest premiums we've seen in years. We have a limited supply, so these are first come, first serve. Next, 2024 1/10-ounce gold eagles are just $44.99 over melt per coin. We also have an incredible deal on XF $20 gold Liberty coins at just $75 over melt, one of the lowest premiums on pre-33 gold we've seen in a long time. And finally, 1/10-ounce gold Britannia are just $29.99 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.